Welcome to today's webinar, compiled and produced by the team at biznews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the biznews.com channel on YouTube. Yes, indeed. I'm Alec Hogg. It's a warm welcome to you. And there's my colleague, Stuart Lohman. Stu, what's the weather like in Cape Town today?
Yeah, we've been blessed the last few days, Alex. It's not so windy. The sun is out, so it's not quite autumny, but you can feel that little, in the breeze. It's there. It's coming. The cold and wet is on its way.
This Johannesburg weather, I tell you what, you're going to miss it as you get into your winter. But it was lovely to be down at the Cape last week, and also fantastic to be talking today after we've got a full month behind us for the portfolio. It was an awful April. In fact, it was the worst April for US tech stocks since 2008. 2008, you might remember, was a global financial crisis. It was the peak of the last commodity cycle. It was a long, long time ago, 14 years ago, and we haven't had such a bad month in 14 years. However, right at the end, as you can see from the headline here, the Rand dulled some of our pain. We had a reverse of 10% in the Rand. That meant that it was a bad month, but it wasn't an awful down month for the portfolio. There are two big issues that I'm going to be concentrating on today, and we'll be unpacking those and explaining why we will be doing what we're doing. And remembering the two portfolios here. There's the web trader portfolio, which is the portfolio that's been going for almost 7.5 years now. That's the one that is through Standard Bank Web Trader. It's a global portfolio, different stocks in different countries over the years. We've had stocks in companies from Europe, companies from the UK, companies from Australia. They've all been part, and of course the US, where the dominant players are. They've been part of the web trader portfolio. And then we've got the new Shift portfolio, which is launched at just about the worst possible time for an exponential stock portfolio, but timing's never been my strongest suit. Anyway, that was launched in December, and that portfolio can be transacted through the Shift portfolio. Obviously, these are both Standard Bank platforms, and Standard Bank is the sponsor of this monthly webinar that we produce for the BizNews community. There's lots of things that we need to get right on the housekeeping before we go into the substance of today. And Stu, do you want to bring us up to date on the tech, making sure everything's working?
Excellent, thanks, Alec. Always good to be here. There's a little control panel on your right-hand side of your screen. If you can see Alec, myself, the presentation underneath, and hear my voice loud and clear, can you give me a high five? There's a little high five button on there. Excellent, Alec. I see the high fives coming through. We also like to keep the questions or get conversational. If you can please put your questions in that same control panel. There's a question mark there. Please put your questions in there, and I'll pass them on to Alec as he runs through what is usually a lovely hour of education. Alec?
Well, let's hope it's education. It's been very educational for all of us in the last month, what's happened on the markets. And as Stu says, post your questions, click on the question mark in the control panel and pose them. And as I say in the intro, the more difficult, the more challenging, the better. I'm not a money manager, so I can't give you investment tips and stuff like that. But these portfolios, these model portfolios, are really there to encourage you to take responsibility for your own investing. And by doing so, if you follow some very basic rules that we propose, you will see that in the longer term, you will benefit. But probably the most important rule right now is just don't panic. Many people, Mr. Market's panicking. Lots of people are panicking. And I like this opening slide because it gives you an understanding that in the 7.5 years that we've had the web trader portfolio, it's still showing an incredible return of over 20% in Rand terms and 15% in US dollar terms. The portfolio was begun in 2014, December 2014. At the time, we were in the depth of the Zuptoid reign of South Africa, where the Rand was only going to be heading in one direction because of the mismanagement of the economy. And our view to the BizNews community was get your money offshore, put your money outside of this country, even if you have to just put it into US dollars, but have a bit of fun with it and try and find yourself some shares that you can invest in because they will outperform the currency over the period. And so they have done, and you'll see that as we go forward. Okay, Stu, just stop me as we go for any of the questions, starting off with the April shower. I call it an April shower, I think, because I don't know how else you talk about a month where, if you recall, it was a really tough month in February. In March, there was a lovely rebound on the US stock market, and particularly in the shares we own. And then April, it was almost like February plus. I thought that it would have been a good time, looking back, to have bought in February, and history probably will show that it was. But anyway, in April, the market went even further down. At the top, Purple Capital or Purple Group, it continues to outperform. Good financial results from the company. They are on an exponential trail. Here in South Africa, I guess because there's so few exponential companies, Purple is continuing to outperform, and they're the owners of Easy Equities. And I know many members of the BizNews community also use that. So they'll use a full stockbroking service here on WebTrader, and then the Easy Equities, which is the low cost option. If you can look at the other stocks, Wilson Bailey did very little, but it took an awful hiding last month after it had to put its Australian organization into liquidation. Microsoft's results were excellent. It was only down by 5%. In fact, immediately after the results, it rose, as did Apple. But then both of them were pointing to concerns about the next month. Remember, both of these companies reported their quarterly results, both Microsoft and Apple. 2U, which is bouncing around like a yo-yo or like a rubber ball, that's 1% of the portfolio now. It's one of those that we're just leaving in there. Xero, the Australian listed company that is the world leader in accounting systems, and it too came under pressure in the past month. Aveng was a surprise to me. It was on results, but when you have a look at a big part of Aveng's business is Moolmans, which is a construction company in Africa that focuses on mining. And if there's any part of the world that should be benefiting right now, it is a construction company focusing on mining in Africa. But such is the mood at the moment that even Aveng is under pressure. Amazon.com, there's a massive opportunity there with the decline in that share price. I'll go into that in some detail. Spotify, its results were not good enough for the market, even though there were things that I looked at that I quite enjoyed about Spotify's performance, but it undershot in areas that some analysts were expecting it would do better in, and that share price down 26%. And then the big loser, the massacred one, Netflix, down 47%. Now, you might well remember from the day after the Netflix results were released, I said we're going to see now what happens. In fact, the morning after the Netflix results were released after the market closed in the United States, in the premium newsletter, I suggested that we're going to see what happens to a exponential stock that goes X growth, and that it wouldn't be in this portfolio for very long. It wasn't surprising to see that Netflix, when the market did open, the pre-market was already showing us it would be down 25%. It was actually down 35% that day. And in the month, it's down nearly 50% at the end, well, where it is today, end of April versus where it was a month ago when we reported on this portfolio in March. That tells you a story in itself, but you can't just jump to conclusions. I've also done some more analysis on Netflix, and we're spending a little bit of time working through that one. Stu, I don't know if there are any questions that we want to pick up now.
Alec, there's one, it might come in with your Netflix discussion, but goes someone by the name of G says, how do you balance the principle of holding for life versus the reality that no company can grow exponentially ad infinitum? Point in case Netflix.
Brilliant, and it's a brilliant question. When you buy into these companies, your approach is that you're going to hold it for life. In other words, you do your homework sufficiently to get to the belief in the company, understand the company well enough, and to see if the underlying fundamentals change, then you need to change your approach. This has happened to us a few times in the past. One very, very unsuccessfully when we sold Tesla at a price which is, wow, it's about a tenth of the current level. That was after there was a lot of scandals going around and we were sucked in by the hype. It's also happened to our benefit with Metro Bank, Barclays Bank, and some of the others that we sold when scandals erupted there. Anyway, the fundamentals of the business, and that's what we've got to have a look at any exponential company. When an exponential company no longer is an exponential company, then I suppose with hindsight, we should have been selling Netflix after the after the last quarter of last year's results. In other words, the 3 months to December. When you start seeing that the exponentiality is no longer going to be there, or so it appears, then you need to take a decision. However, what happened with Netflix was after those results, there was a very upbeat forecast, or relatively anyway, for the next quarter. And if you also, actually, we must get into the Netflix story. There we go. You can see what happened with Netflix here. The share price has now fallen back to 2017 levels. And the reason for the massacre of the stock was because it lost 200,000 subscribers in the first 3 months of this year. That was what it reported, as against a projection of gaining 2.5 million. And it also forecasts it's going to lose another 2 million subscribers in the second quarter of the financial year. Now, remember the base that Netflix is working off is 222 million subscribers. So the question you have to look at now, is this a X growth for Netflix, and is it X growth across the board? Also, you need to have a look at the current share price and say, is it fairly reflecting the value of the company? So my initial reaction was, well, it's not growing subscribers anymore. Netflix is going to be X growth. The consequence of that is that the rating will be adjusted accordingly. And this is an exponential portfolio. So we've got to that point that G mentions where you need to reassess and say whether you hold on to it or whether you dump it out of the portfolio. What made me, or gave me pause, was that revenues actually grew 10% year on year in the quarter. So although the subscriber numbers are falling, the revenues are not. Well, that's the first thing. And then I pulled out figures for the last time that Netflix was at this share price and pulled the fourth quarter of 2017. You can see there. So it's 1, 2, 3. Was it 1, 2, 3, 4.5 years ago that it was at this share price, and said, well, what were you buying at that stage? Because that was what it was valued at that stage. And what you were buying then was a company with revenues of 3 billion a quarter, 3.2 billion, subscribers of 58 million, and free cash flow of minus $500 million. So there was no certainty that the free cash flow was going to be positive. There was certainly, you were hoping that the subscribers would grow, but in 4.5 years, if you'd said the subscribers would go from 58 million to 222 million, I promise you would have bought as much Netflix in the last quarter of 2017 as you could have. And similarly, that revenues would more than double, up 146% from that last quarter of 4.5 years ago. So I look at that and I say, well, okay, those people who were buying, if we were buying or we held the stock in December 2017 and we had this outcome, would we have been satisfied with the outcome? And I say, well, much more than satisfied with it. So the consequence that you have to be looking at now is perhaps Netflix has gone X growth, as it were, and there's good reasons to say it hasn't. But anyway, perhaps Netflix is not going to be growing its subscribers that strongly, but you only really go X growth when your revenues go the other way. Netflix, in its quarterly result, because it undershot on the subscriber numbers, it became that became the banner headline, and that's what everybody focused on. But what they didn't focus on were a couple of reversible issues. So here's the reasons that Netflix gave for not being able to make those subscriber numbers. The first thing they said, it's been brought home to them in this quarter that the pace of growth that they can achieve every 3 months, and don't forget, this is a 3-monthly report, a 3-monthly snapshot of the company, is that the pace of growth which they've been happily projecting is actually not dependent often on factors outside of their control. So they're going to be a lot more conservative now on the pace of growth, which is only right. Secondly, they say that of the 220, although they've got 222 million people who are paying for Netflix, there's another at least 100 million people who are using their passwords illegitimately. So the way they look at this is that they can, if they tighten up their password sharing protocols, they've got 100 million people who actually do like Netflix, but are just not paying at the moment, who they believe will actually start paying. So that's another point, quite a big bullish point there. And then the third point is that competition for streaming has intensified. Now, we've been told by Reed Hastings, including in the last set of numbers, that streaming is still a very small part of the total TV market. And here you can see the little pic that we put there, the image that we put there on the left-hand side here. And you can see that the total streaming market in America in February 2022 was under 30% of US TV time. So the potential that Reed Hastings has always been talking about is there's a heck of a lot of road for streamers. And Netflix's share of the US market is only 6.5%. Actually went up as you can see in the last year from 6 to 6.5%. So his view is that Netflix has got a great product. It's investing heavily in content. It's going to continue to grow into the future, and it's actually competing against free-to-air stations. But for the first time in this quarter, and this is what spooked a lot of investors, he also said, but we're seeing lots of issues coming in from competitors now. And he mentioned that, as you can see here, Prime Video, Disney Plus. I don't see Apple in there, but that would be under other streamers. Lots of people are moving into the streaming market. YouTube has been, I would have thought it would have had a bigger share than that already, but clearly not. And that's gone down a little bit in the last year, which is interesting, and says quite a bit about the whole Alphabet story. But competition is now hotting up. The real issue to me is that streaming is eating away at the free-to-air or the whole network TV time. Viewers are acquiring streaming much more, and we can see this in South Africa. If you drive along past any informal settlement, even where squatters are, you'll see that a lot of the dwellings have got satellite dishes, a lot of them. And the bottom, the price in the South African market, multi-choice, is not much different to what you would pay for a Netflix subscription. There's not much difference here in South Africa. So there's a massive, massive market in South Africa as an example, and clearly in other parts of the world. So you start on that side. And Reed Hastings also said, or the letter to shareholders also said, that macro factors had an impact. worries about inflation in America, the war in Ukraine, sluggish economic growth. Something that hasn't really raised its head yet amongst analysts, but is very, very important, is the way that COVID is now giving the Chinese economy another hammering. What happened in China first time around was they locked down everybody and they had very few COVID deaths. But the problem is they also didn't have much of a vaccination drive. And because of the one-child policy, they have very much of an aged population. So you've got old people who haven't been vaccinated. How do you protect them now in an environment where, even though it is perhaps not as deadly, and we know that for sure, but the latest COVID, Omicron, I think it's not to be fooled with. So, and it is incredibly infectious. So now the Chinese they've locked down Shanghai for 6 weeks already. This kind of news, initially we thought, we've had Omicron and we know what's happening, but it's not going to impact us here. But the reality of that is that in China, it's a different story. And there's all kinds of political overlays to everything that's happening there. They came out and said, look how good we were, how stupid the West were. Suddenly, it's not so much the case anymore. With China locking down its economy, the impact on supply chains is massive. So there's all of these knock-on effects, which was mentioned by Reed Hastings. The point about all of this, though, is you've got to look at Netflix in context and say, okay, it's gone X growth, or it's not growing to the degree that we were expecting, exponential growth, the degree we were expecting. What do we do now? Had Netflix been sitting at $350 a share, you'd probably have very good reason to say, whoa, we've got to get out of here. Netflix sitting at $200 a share, you got to reassess and say, is it actually smart to be selling today? I also hate selling immediately after Mr. Market takes a panic, unless there's a very good reason to do so. And in this case, we aren't selling Netflix. We're holding on to it at least for the next little while.
Thanks, Alec. Sean just adds to that discussion. He says, what about the competition? He mentioned CNN Plus closed after just 1 month. So he says not showing a signs of a downturn. It might not be saturation of a market. So to have a foot in is a good thing.
There's something very big happening here as well. And you have to look at the alternative media to kind of get this. When Helen Ziller wrote her book about Go Work, Go Broke, I think a lot of us thought, not a lot of, I didn't think so, because I have a huge admiration for her, but many people who read the book thought, she doesn't know what she's talking about. She's talking her own book, etc. But increasingly we're seeing that the wokeness, the woke approach is not working. Now, CNN is the flag bearer of wokedom, if you like. So it does not surprise me to see CNN streaming service not being successful. What we have seen on Netflix is that they really were tending towards that, towards more of the if you like, politically correct, acceptable content, which has had an impact, no doubt. But I was very interested to see that they have cancelled the Queen of Workdom's cartoon series, Miss Markle, and they've also it might be too early to tell, but it's almost like they're moving away from this politically correct kind of approach, which is great for the reviewers, but awful when it comes to having a look at the commercial side. And I'll just point you to what happened at Amazon 2018. They brought out 2 series then simultaneously, which cost about the same amount of money. There's one of them is called The Man in the High Castle, which is a series based on the science fiction, thankfully, that the Germans and the Japanese had won World War II and what the world would look like then, and that they'd break up America into 2 warring parties. That was a huge success. It added something like over 1 million subscribers to Amazon Plus. And they know this, Amazon Prime rather, they know this because they see when people subscribe to Amazon Prime, what is the first thing they do? And more than 1 million of people who subscribed at that stage, the first thing they did was go and watch the series. They also spent a similar amount of money, and the cost of acquisition there was about $63. They spent a similar amount of money on a mini series which was to do with gender balance. In other words, a very woke mini series. Same cost, about $80 million, but it only got in 50,000 subscribers as against 1 million. And Amazon learned very quickly then that, sure, it's good to be politically correct for the media and the mass media and politicians, etc., but it's not very good business, like Helen Ziller wrote in her book. Now, I'm not saying what's right and what's wrong. All I'm saying to you is, as an investor, you've got to be investing where your money works the hardest. And Amazon learned that lesson back in 2018 and has not repeated the mistake. You get a similar feeling from Apple TV or Apple Plus that they're staying away from promoting the woke or the critical race theory strategies, etc., because people just aren't buying it. Whereas Netflix is only now coming to that realization, and that might be something that hasn't been worked into these numbers. So there are many ways of trying to dice and slice and look at this, etc. But I think it's such a complex field, and there's so many inputs, and that's all I was doing by talking about the programming, that you need to be aware of what it is that you're buying. Have a look at it, whether it's value or not value. At $600 with Netflix growing at 20%, it was value. At $200 with Netflix growing at 10%, is it still value? Should you be selling now or not? It's too soon for me to tell. And I think that that given that it is a fantastic company and it is a business that's back at, as I said earlier, on those numbers, and they're very important to look at that. Your 222 million subscribers is against 58. That's a lot of people, 222 million, with another 100 million potentially who are in the ambit. Well, we know from a business like ours that when you have that kind of loyalty, when people actually subscribe for your service, there is much else that you can expose them to that they would be happy to support you with as well. So Netflix hasn't even gone there yet. They've started with a little bit of gaming and things, but that's a lot of people, 222 million, who are paying you every month. And I think we certainly mustn't jump too quickly on this one.
Thanks, Alec. The other questions are around Amazon and Twitter, which I'm sure we can pick up when you get to them.
For sure. Onto Amazon. Okay, so massive sell-off, not a Netflix type sell-off, but almost as bad in my favorite share. Well, my favorite long-term share, my favorite cornerstone stock. It fell 14% immediately after the results. Took the decline for the month to 23%. The reason for this is because management said there was a $6 billion hit from supply chain impact. Now, remember, when you start looking into Amazon, into the innards of this business, there are a couple of big things that are going on there. It's got its own fleet of ships. It's got its own fleet of planes. Amazon decided years ago that it wanted to not be vulnerable to supply chain. So it can get the product from China into the United States, which is its biggest market, or other markets, big markets that it has around the world. It's also got the warehouse to delivery to door sorted out. And indeed, it's even experimenting, as we well know, it's been well publicized, with drones delivering from warehouse to door. Where it doesn't have full control is from the suppliers. So the supply, in other words, the manufacturer in China who can't get his people to work because he's been put into lockdown. Nothing they can do about that. But they've made a huge impact on what they can do. They've influenced a lot of what they can do. And they are forecasting that because of supply chain issues and inflation, they lost $6 billion as a result of that in the past quarter, and they are projecting another 4 billion hit to profit in the second quarter. But when you're buying Amazon, you're not buying it on supply chain or temporary supply chain disruptions. You're buying a machine. You're buying an incredible thing that Bezos has made. You're buying the flywheel. And the flywheel at Amazon is spinning just as quickly as ever. The growth in sales, this also got Wall Street a little irritated, because for the 3 months to the end of March, the sales were up only 7%, but that comes on 44% in the same quarter a year before. So now, if you just halve the two, then you're talking about exponential growth continuing. So this was the slowest quarter year on year in 20 years, but you've got to look back at its direct comparable, which was up by 44%. So there are good reasons why I'm ignoring this as a temporary blip and viewing it as a purchasing opportunity or a buying opportunity.
Exactly. Just on Amazon.
Question?
Yes, he says they're facing headwinds saved only by the web services. What's the future driver for Amazon? Have they not peaked during the lockdown?
Sure, that's a hell of a statement. No, not at all. Not at all. Amazon is a phenomenon. Anything that Amazon looks at, it can get into that field and dominate it. And you can see this continuously when Amazon suggests they're moving into, for instance, pharmaceuticals or distribution of pharmaceuticals. Then existing distributors of pharmaceuticals, the share prices fall immediately. Any area that Amazon targets, because of the deep data that it has of its huge base of customers, it's a flywheel that is spinning rapidly and continuing to spin rapidly. The money that was made in Amazon Web Services was done because Bezos saw the cloud 7 years before anybody else did. So they went in early and they made the investments early. They have the market share there, which is 7 years ahead of anybody else. And everybody, all their competitors are trying to catch up by spending lots of money trying to get closer to Amazon. One of the things that has driven Amazon over the years is a very good relationship between the company and its labor. And there's a bit of skittishness because trade unions are starting to get their hands on labor within Amazon, but they were soundly defeated. In New York, there were 2 votes, and the one vote went labor's way or trade unions' way. The other one was decisively rejecting trade unions. So that is a challenge that is being faced. But this is not a company that you can simply say has benefited from. It's not a tiny little business. This is a massive organization, the biggest retailer in the world now, and it is an organization that is beautifully positioned for the 4th industrial revolution. And I guess that's really where it all comes down to. You either believe that what happened in the past is a good measure for the future, or you say we are going through a period of disruptive innovation, massive disruptive innovation. If you buy that story, if you buy the 4th industrial revolution story, as hackneyed as that description is, then you have to know that those companies that are positioned for it are going to be outsized winners, and the companies that are not positioned for it are going to be outsized losers. And that's really where you go in this. And for me, there is no business in the world that is better positioned than Amazon for the new era that we're entering into, where the marketers dream of one-to-one marketing, of actually having a market of one, is going to be the reason why you succeed, rather than trying to sell product to people you don't really know. In Amazon's case, they know so much about you or about its customers. They know what its customers bought. They know what its customers are listening to. They know what its customers are watching on Amazon Prime. They know so much about them, and the data is so deep that it gives them an incredible advantage. It's a little bit like Apple. A few years ago, when we bought into Apple, the shares were about we bought $120. They went down to $90. And I remember in those times, the webinars, there were lots of questions about, this thing's gone X growth. The iPhones are not growing. They're not selling as many iPhones as they were previously or expected to. Samsung is a very strong competitor in the iPhone market, etc. And my response to that was that my belief about Apple is that there's an ecosystem, and that ecosystem had not been priced into the stock. And that ecosystem comprises more than 1 billion devices. The ability I have, for instance, to take something from my phone and airdrop it onto my desktop or onto my iPad without being connected in any other way is not something that you just suddenly get. It is a result of the strategy that Steve Jobs implemented in maybe 1997. We can go back to that time. Certainly, it was implemented in 2007 when the first iPhone was produced. So that's the reason why Apple has been such a phenomenal success, in my belief, is because they have this ecosystem. It's that flywheel. It just, every new person who buys an Apple machine increases not just by one, but by many, because it can buy from lots of different Apple options. And Amazon's one of those too. It's got a massive, massive customer base, and you can't replicate that. Warren Buffett says that in not this time round, but in the previous Berkshire Hathaway AGMs, he was often asked about Amazon, and he said it was the one that got away from him, the one he never bought into and he made a mistake on. And possibly because of that, he did buy into Apple because it's got a similar business model, and Apple has been by far the best performer for Berkshire Hathaway over the past few years, or since they bought in.
Thanks, Alec.
Okay, so that's Amazon. You can hear I'm a big fan of Amazon, and there'll be a concrete issue coming up a bit later.
I think Twitter's in the Shift portfolio, so do you want to wait till you get to that, Alec?
Yeah, let's do that. We can talk a bit more about Amazon and Twitter in Shift. The reversal, I tell you what, the Rand has dropped dramatically in the past couple of weeks, 14.50 to over 16. And that helped the portfolio. As you can see, the web trader portfolio was down 16% in US dollars in the month of March, only down 8.5% in Rand. So it's been a horrible, horrible, horrible month. But in Rand terms, it wasn't as bad as it might have been. And here's the big numbers. As mentioned before, I thought that February, after the decline there, would have been a good time to reassess and maybe to add to the portfolio. Well, that didn't turn out to be right, because there was a big bounce in March, and then April went even lower than February. You can see that the portfolio, which started at 2.2 million Rand in December 2014, is now 9.2 million Rand. So it's done very well over that period. And that's what you get when you get a 20% compounded growth rate. But it was down 8.5% in Rand during the quarter, which is, you can see our US dollars, because Amazon actually performed so poorly, that was down 23%. We underperformed the NASDAQ index. Also, in NASDAQ, in the NASDAQ index, Tesla's there, and that did okay because they came out with good financial results. And then the S&P 500 index, which is the old economy stocks to a large degree, that was also down by 7%. So it isn't, we aren't sitting at a point and saying, well, you guys who are looking at the future and companies that are going to be growing into the future have got it all wrong and they're going to be smashed. It's not just them. It's been a really bad month for all shares. 7% decline in the S&P is significant. The JSE was helped a lot by the Rand, because the Rand hedge stocks would have picked up as a consequence of that. And you can see there's the portfolio itself. We started at 11 Rand 27 Rand dollar. It's now 16 Rand and 7 cents. And the compound growth, 15% in dollars and 20% in rands. These are nice to look at because they give you an understanding. It's back in the last 2.5 years. You can see pre-COVID, the portfolio was sitting at just under 7 billion Rand, and it's now sitting at over 9 billion Rand. So take COVID out of it, you'd have bought it in 2 years for sure. And there's the performance in US dollars. It's gone from around 400,000 Rand to, as you can see, just under 600,000, sorry, dollars to $600,000. Right, the shift portfolio, and then we can get into all of those questions. That was started in December, which was just about the peak of NASDAQ, very close to the peak. The focus of the shift portfolio is exponential, and it's a 5-year game. So anybody who goes into this portfolio and thinks they're going to get rich quick, please just rather sell everything now and go and trade on horses or something. But this is investing into companies that are well positioned for the mega trends that the world is going into. Invesco, which is the biggest part of this, Invesco is the exchange traded fund that is invested in the NASDAQ 100. So it actually reflects what happens in the NASDAQ 100. And as you can see, had we just put all the money into Invesco, we would have been 11.7% down. What happened here, by the way, was it was $10,000 in December, $10,000 in January, $10,000 in February. And it's my own money that I've put in there. So this is very easy now. I can just look at Shift and pick it up. And in fact, I don't know if you guys have not played around with Shift before. I'll just show you quickly. That's what the homepage looks like there. It's quite nice with an Apple because it logs in using Face ID. And there's the portfolio, or rather, let's do that. There we go. That's a bit better. That's the home screen. And then you can look at the shares that are held in this portfolio. And there it is. As you can see, if you can see closely enough, the figure there, $24,235 is where it is at the moment. And that's after a starting of $30,000. So down 19%. What happened? Well, if you look on the right hand in the profit loss column, you'll see Netflix has been a real hit for us here. It was one of our 3 bankers, unfortunately, and it's really taken a caning. The other one that's done really badly has been Spotify, which surprises me, and then Zoom is down by 33% as well. So these are certainly Spotify, Zoom, Uber. I'll get to the Bitcoin ones in a moment, but the way the portfolio was structured was that you'd have Invesco, which is the exchange traded fund, about 35%, then about the same amount in Apple, about 45% in Apple, Microsoft, and Netflix. They were our 3 bankers. Apple and Microsoft have done fine. If you compare them, they're down half of what NASDAQ is down, so they've held their ground very well. Netflix, being the banker that fell out of bed, that has been the one that's really hurt this portfolio. And then we had wildcards, and the wildcards were Cloudflare, Twitter, 2U, Spotify, Uber, and Zoom, 5% in each of them. And of those, the best performer has been Twitter by far because of the takeover bid from Elon Musk. So that's one wild card that we can get rid of now. He's said he's prepared to pay $54.20 for it. It could happen 6 months to a year. These things take a long time to settle down. It just makes sense to free up that cash because at best you're just going to hold where you are now. If something crazy happens and the deal doesn't go through for whatever reason, then you wouldn't be getting that $49 or the 27% return, which is not bad when you've only held it for about 4 months. So although I always believe you should be buying into a share forever, in this case, Twitter is going to be delisted from the market. So it doesn't make any sense. A little bit like what we did with Slack. You might remember we had Slack in the other portfolio, and then Salesforce came and made a deal, made an offer, and then we sold out of that. Then of the others, you can see it's very predictable. These are disruptive technology shares, companies. Cloudflare is the dominant player in the international securing of websites, of the internet. 2U is the dominant or the leading player in online education. Spotify, the leading player in podcasting. Uber, I think it's we know what Uber is about with its taxis and food, and then Zoom being the leading player in this kind of technology, what we're using right now to get to you. Although this is not on Zoom, this is on GoToWebinar. You'll see there, though, that last month we began purchasing Bitcoin. MicroStrategy, which is a company that has got more or the value of its Bitcoin is worth more than its market cap, and then ProShares Bitcoin ETF. So we've put 4% of the portfolio into Bitcoin already, and I've decided for the moment we're going to stop it right there. Reason for that is that Bitcoin is getting a lot of flack at the moment. Warren Buffett was at it again. I don't necessarily believe that this is the end of Bitcoin, not by any means. But while there is so much resistance against an asset class, it doesn't make sense to keep doubling up and tripling up. The idea was that we'd buy 1/3, 1/3, 1/3. When I talk to even long-term value investors, they'll say you should have between 3 and 5% of your portfolio in Bitcoin as an insurance. So right now we're going to leave it as an insurance at 4%. So that's really the shift portfolio. What are we doing? Oh, I put this together just to show you the benefit, and please apply this in all of your purchases. Whatever you're doing, try to buy into whatever you're buying a stock, particularly if you're buying offshore, stagger it over 3 months. We didn't do that with Bitcoin, but there are reasons why I'm actually stopping that at the moment, and I hope I've articulated that properly. But had we put everything in on the 14th of December, we'd be at the moment 18% worse off overall, whereas 7% worse off than the current NASDAQ level for what we bought in January, 2.5% in February, and 1.5% from March. So that just gives you an idea that sometimes it works with you, sometimes it works against you. But in this case, very, very much the dollar cost averaging has been a benefit. So what are we doing today on the shift portfolio? We're stopping the crypto investments. It's 4% of the portfolio. It's adequate insurance. If we carry on to do 1/3, 1/3 as we were proposing, it would have taken us to 12% in crypto. That's a big bet in crypto, a very big bet in crypto. And right now, the markets are incredibly volatile. Crypto's got a lot of headwinds. It's happy to have 4%, no problem there. We're selling Twitter after Musk's offer and investing into Amazon. The intention is to buy one Amazon share this month. Next month, Amazon will have I think it's a 20-for-1 split. So we'll have the one Amazon share now, which will become 20 Amazon shares in a month's time. And we will then buy 20 more Amazon shares then and 20 more Amazon shares the month thereafter to bring Amazon in as our new banker, because clearly Netflix is no longer a banker. That's dropped to half of its other level. So that's what I'll be doing in my shift portfolio tonight. And for those who want to follow it, yeah, be my guest. So Stu, that is the portfolio, both of the portfolios. Then I think brought together. It was a lot to talk about, but let's see if there's time for some more questions.
Thanks, Alec. Just on Bitcoin, Justin wants to know, why have you invested in a Bitcoin ETF rather than directly into Bitcoin itself?
It's the same thing, Justin. Bitcoin ETF it's fractionized, really. This is a portfolio that started with $10,000, $10,000, $10,000 to try and keep it within range of most people. One Bitcoin is going to cost you $38,000. So it's more than the whole portfolio. So it was just really a practical thing.
Thanks, Alec. Ian just wants to know, are there any wild cards in renewables or healthcare that you may be considering?
I like this teledoc of Kathy Woods, and I know it's got terribly bad press recently, and the share price has fallen like a stone. I think it's like 80% down on where it was a little while ago. But it makes sense. I need to do more research into it. But if you look at what Discovery did here in South Africa during the pandemic by opening its partnership with Vodacom, I haven't got the final numbers from them, and indeed, it's a good call because I must find out or speak to the guys and see where they are. But that's one that does need some more research, definitely on the healthcare side, and we are paying a lot more attention now to healthcare, I think, than probably ever before, given what happened in the last 2 years. There's I've been trying to find exponential companies that dominate their market space, and that's what this portfolio, that's what the wild cards are. Now, you always have the risk that the big guys are going to get their act together and going to squash you. And we could see that with Netflix, for instance. If Amazon, Apple, and particularly those two, HBO is also very, very strong as well, which is part of, I think it's anyway, one of the big American companies. They could tackle and give Netflix a really hard time. But usually the one product focused company in an exponential area is the one that wins. And we've seen Cloudflare do this. It grows at 50% year on year. And when you start extrapolating those numbers, you can see, and it still has a huge part of the internet that it can secure. You see what the potential growth is for a company like that, and it's massive. Uber, what's the potential growth of Uber? Zoom, there's the argument that's going on now is to say Zoom, Uber, even Spotify to a degree were stay-at-home beneficiaries. I don't believe that at all. My view and what we've seen from BizNews is that the acceleration came much faster than we thought during COVID. When people were at home, the move to digital was huge. But just the fact that you're on this webinar now shows, and we're getting hundreds of people who come to webinars, even though the hype around webinars, if you like, is over and we aren't all staying at home. It shows that it's a new tool that people have embraced, a new digital tool that people have embraced. And there are many of these digital tools that people are really in the news industry. They're absorbing their news much more from things like YouTube videos and podcasts on Spotify than they were in the past. They might have been watching television in that, and it's a similar thing, or free-to-air television. It's a similar thing across the board. The digital world was accelerated and brought home to us by the COVID pandemic. When you have a look at the Great Resignation, as it's called in the United States, and we're seeing it in South Africa, those who can afford to resign are doing it because they say, I don't want to go and spend an hour and a half in the mornings getting into my office. Why should I do that? Why can't I stay at home and be more productive and actually be closer to people that I love? Maybe go into the office 1 or 2 days a week. Of course, it doesn't suit companies who've got massive office commitments. But as this all winds out, that fight will probably calm down, and we'll see a move to a more digital world being more deeply entrenched. So that's where my head is on all of this stuff. But there are others who feel that we're going back to where we were before COVID.
Thanks, Alec. Charles just wants to know why you reduced the Invesco QQQ stake. They used it for.
Okay, Charles, thank you, and for pointing that out because I should have actually explained it. The Invesco QQQ, that's the exchange traded fund. That's there to be used to be almost as a float, so that you sell the exchange traded fund when you find better investment opportunities. And so I believe that Amazon is a better investment opportunity than the float. Invesco gives you the exposure to the whole of NASDAQ, but if you can find something better. And so what happened here was that we sold the 33 Twitter that we owned, or we're going to tonight when the market opens, and that'll generate about $1,622 in cash. But you need nearly $2,500 to buy one Amazon share at the moment, before, this is pre the split, of course. And so you needed to get the money somewhere else, and there it was from Invesco, the 943 that you'll raise in that way. So this portfolio that you see here is pre the Amazon purchase. So Invesco will then go down to 22 in the next, and Twitter will go out of the portfolio. So there'll be 22 units of Invesco and no units of Twitter, but one Amazon share after the trades tonight.
Thanks, Alec. You used that similar strategy on the web trader with the Vanguard, didn't you? And the Berkshire stakes.
Exactly the same. When we started off with WebTrader 7 years ago, we had the S&P 500 index, Vanguard S&P 500 index as a float, and we even had Berkshire Hathaway as another float. So it was very conservative when we began, and progressively we sold off those. Berkshire is really, it's a massive, massive conglomerate, an $800 billion conglomerate with some investments, $200 billion or $300 billion in investments, whereas most of what Berkshire has is in unlisted companies spread right across the US economy. So you're getting a feeling of the whole US economy. So it was an idea that when we found something better, that we thought would be something better, we could sell off that flat. So yes, exactly.
So like Sean just wants to know, any comments on the latest Berkshire get together and what they purchased?
Yeah, it was interesting to see Warren Buffett having a punt on Activision. The skeptics will say, well, he does know Bill Gates is not on his board anymore, but he does know Bill Gates quite well. I don't know if they're still playing cards, and although Bill Gates is not at Microsoft anymore, you can be sure that Warren knows when Microsoft is making a trade or making a potential acquisition. They've done their homework, and so he's arbitraging it. He's arbitraging Activision. There were people who said, but hang on, he was buying into Activision before the announcement from Microsoft, so that was a little bit controversial. Anyway, I doubt it. I don't. Warren Buffett has got too big a reputation to risk there. He likes the old economy stuff. He doesn't like crypto. I'm battling with this. I read a book about Phil Fisher, Uncommon Returns from Common Stocks. Phil Fisher, when you ask Buffett, he'll say he's 15% Phil Fisher, 85% Benjamin Graham. And we all know about Benjamin Graham, but in Phil Fisher's book, the thing that keeps coming back to me, and forgive me, because this is I've been a Warren Buffett fan for a long time, but it's written by his son, the intro. And he said, I'm so sorry that my father didn't stop investing earlier, because as he got older, his mind got more concrete, and he made the worst mistakes of his life as he got older. Now, it just keeps coming back to me, that thought. And it's Warren Buffett is an absolute genius. He's shown he's a genius over many, 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 many years. But to be coming out vociferously about things that, I don't know, there's other very smart people like Elon Musk and Peter Thiel and, well, our own Stafford Marcy here in South Africa who explain, I think, quite well what the whole crypto story is about. And certainly the stuff I've read, I get it, that if everybody believes it's a store of value and you aren't going to issue new digital coins, new Bitcoins, then, and people believe that it is a store of value, how can we criticize it? How can we criticize them when we have a fiat currency world where the politicians can just issue as much as they want? And yet Buffett seems to, well, he not seems to, he totally rejects that argument and says the store of value is the US dollar. So anyway, But that thing of Phil Fisher comes back to me, and I don't know which way. All I can say to you is that you got to respect the man's track record and his opinions and his understandings. But I guess not everybody can be right all the time, and maybe this is one that he isn't right on.
Thanks, Alec. That's brought us to the top of the hour. It's a pretty good place to stop.
Yeah, the whole Buffett Berkshire. I used to make that trip religiously every year, and it was 2014. I remember being there. I was looking at my reading today. It was on the 3rd of May, because the reason he has it in May, he always has it the last Saturday in April, but the reason they have it in May is when it clashes with Mother's Day. Every now and then in America, the last Saturday in April clashes with Mother's Day, and then they move it out. He moves Berkshire out for a week because he says that his shareholders would rather celebrate Mother's Day. Interesting little aside, that one. But yeah, it was a Berkshire where you got the feeling that the guys were repeating a lot of what they've been saying for a long, long time. And the fact that Buffett spent $40 billion, took his cash pile down from nearly 150 to $100 billion in the first quarter of this year, tells you that certainly they are, although he says it's a casino, that there were lots of people who were coming in and just trading punting shares, which in the past year I'm sure that is the case. There was value to be had, and I suppose the divergent view now has to be: has the exponential bus been derailed? Has disruptive innovation, has it died? Does it not matter anymore? Are those companies that are disrupting through innovation going to continue to grab shares of the market? And as a result, as a co-owner, are you going to be happy to own them? Or are you rather going to be better served by going to, and the classic example is banks. Buffett has got many banks in his portfolio. And a big part of his portfolio is in financial services. But when you have a look outside at the challenges that are coming at banks right now, from all over, the whole DeFi wave, the whole fintech developments, the next generation in payment systems, and so on. Those are questions that I guess you take your bet, but when you invest in these portfolios, these disruptive technology portfolios, disruptive innovators, know that it takes time. Google took a long time to make a profit, and Alphabet's one of the biggest companies in the world today, the parent of Google. Tesla, the projection for Tesla is that in 4 years' time, they're going to be autonomous taxis. So what you're going to be doing is hailing a taxi online, and it'll come there with no driver. Perhaps not in South Africa so much, but certainly in the US and in other advanced economies. And the Tesla will be and is going to be the leader in that field. Now imagine the size, the scale of that market opportunity. And hence, people those who believe in Tesla believe that they're going to be a big beneficiary from it. But then you would, on the other hand, be betting against it by investing, I don't know, yellow cabs in New York and black cabs in London. The world's changing. I see it. And maybe it's the rapidity of the change and the value that is available for those companies that are changing versus those companies that are not going to benefit from it, where you need to take your differences. And my feeling on all of this is that you look for companies that are going to be beneficiaries of the fourth industrial revolution, like those that we've got, some of the wild cards that we've got in here, and then try not to fiddle with them. Try not to change them. Hang around for 5 years. And by that stage, you would have had sufficient time for them to have realized their potential. Long story short. Sorry.
Excellent. Thanks, Alec. I think we can leave it there. We'll get the video for those who want to have a repeat. We'll get it up to YouTube as soon as possible after this webinar. But other than that, yeah, we'll also send the dates a bit early. Alec, I know we're a bit, the holidays threw everything out a bit for this month, but we'll make sure. Although I know we got WEF as well at the end of next month. We'll work out a date soon.
Yeah, we might have to be talking to you from Switzerland, which could be quite fun. Anyway, let's play out with our signature tune. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.